But thanks for those who are coming today and for everybody who's watching this afterwards. My name's Peter Casserole. I'm the Executive Director of the SouthGrow Regional Initiative, and this topic is part of our annual Lunch and Learn series, where we basically bring in experts to talk about issues of importance to the region so that we can share out the information and all learn a little bit more about how to get the most out of the economic environment out there. So our speaker today is Devin Vornbrock, who's a CPA and tax manager and client advisor with Avail CPA, one of Southern Alberta's premier CPA firms. Devin specializes in helping Alberta businesses to navigate complex tax planning, government incentives, and growth strategies to maximize their investments. He's a graduate of the U of L's Dillon School of Business, where he was awarded the gold medal. Wow. And he also earned a place on the CPA Common Final Examination Honor Roll, recognizing him among the top 1% of CPA writers in Canada. Today, he'll be sharing practical strategies for combining tax credits and grant programs to help Alberta agribusinesses get the most out of their projects and investments. So please help me join me in welcoming Devin Vornbrock to talk to us today.
Excellent. Thank you, Peter. That was a good introduction. I like it. Oh, I like the
Yeah.
little hands. That's nice. Okay, let me share my screen here. Sharing is not turned on. Someone needs to turn on sharing for me so I can share my
That will be
presentation.
Madison.
I'm on it. One sec. I thought I
Okay,
had it. I guess not.
sounds good. No worries. I'm sure you've all been waiting with anticipation to hear me talk about maximizing tax credits.
All right, we should be good now. Try that.
Okay. Let's see if this works here. Screen one. You guys see that? Someone needs to say
It's
yes.
just black yet.
Okay,
There we
Oh, there
go.
we go.
There we
it's
go.
working. Okay, perfect. Alrighty. So I've gotten a great introduction to myself, so I don't really feel like I need to add anything to it. I guess a couple things maybe I will add is kind of what my role is now at Avail. So in addition to having my own clients, I spend a lot of my time providing tax advisory services, primarily to our Eastern region partners. So all of kind of our partners and client advisors, we call them, those that are responsible for a group of clients out in the Tabor region. So a lot of what I do with that tax advisory work is, estate succession planning, as well as looking at some of the, investment tax credits that we'll talk about today. So before I jump into the actual tax credits themselves, I have this slide here where I just kind of wanted to go over some of the common questions we get as far as when we're growing, when we're buying, assets, equipment, whatnot, from a lot of our clients. And these are some of the questions that I hope to be able to help answer today. Everyone's situation is obviously very different, but in general, hopefully I can help answer some of these questions. So common questions we get, how do I fund a new facility or expansion? What are some options I have to, minimize the cost of that? How do I lower the cost of new equipment? Which credits can I apply for, as well as can I combine multiple credits in order to lower the cost? And then in addition to credits, something I'll also talk about is what grants exist beyond tax credits, because there is unfortunately not a ton of tax credits out there at the moment, anyways. There are a substantial amount of grants at all points in time. So I'll chat about that as well in a bit more detail. One thing I want to talk about before I get into the tax credits is actually what the difference is between a tax credit and a tax deduction, because I think people tend to get this mixed up a little bit. So a tax credit is a dollar for dollar reduction in your taxes owing. So for instance, if you spend $100,000 on something, you have a 30% tax credit. That is a $30,000 tax credit that reduces your taxes owing, or in some cases, you just get a straight refund of $30,000. So that's a tax credit. A tax deduction, on the other hand, just reduces your taxable income. Doesn't reduce your taxes owing, reduces your taxable income. So in my example of $100,000, if you have a $100,000 tax deduction, it reduces your taxable income, and it's really only worth your marginal tax rate. So in Alberta, for small businesses, CCPCs, Canadian controlled private corporations, first $500,000 is taxed at 11%. You have a $100,000 tax deduction, you get it reduces your taxes owing by that 11% or $11,000. So worth mentioning, because I think people tend to use that term interchangeably, and they're quite a bit different. So we're focusing on tax credits today. So the tax credits that I want to talk about, first off, I'm going to talk a little bit about SR&ED, which stands for Scientific Research and Experimental Development, and then Alberta SR&ED, which for some reason they had to choose a different name than SR&ED. They chose Innovation Employment Grant, but it's essentially the same thing. I'll talk about the Clean Technology Investment Tax Credit, Clean Electricity Investment Tax Credit. Apparently there were some questions about the Alberta Agri-Processing Investment Tax Credit, so I'll talk a little bit about that one, as well as the Apprenticeship Job Creation Tax Credit. And then I'm going to talk about some of the ways to maximize our credits by utilizing other sources of funding, which is, grant funding. So I'll talk about SCAP, a couple other grants, and then I want to talk about the decision of buying or say leasing equipment or assets, because that does play into these tax credits as well. So, okay. So first thing I'm going to talk about is SR&ED. SR&ED, again, stands for Scientific Research and Experimental Development. And it can be a very valuable tool for businesses that are investing anything in R&D. So, I've seen this with a number of clients in the agriculture industry. If they're providing some sort of innovation in a process, or they've developed. I've had clients build apps, build technology that is helping them with their operations. That could potentially be eligible for a SR&ED credit, as well as the Alberta SR&ED, which is the Innovation Employment Grant. So really, it's used to help fund any innovation that you have going on your farm. I find this is actually probably a fairly underutilized credit among producers, or even just any small business. It's something that, if you're doing any sort of R&D, it's something to consider. So I'll just talk about the credit itself. Maybe before I do that, I'll even mention that, potato growers would be familiar with SR&ED a little bit, because any PGA levies that they pay, some of those PGA fees go to R&D work that the PGA does, and then they get to claim a little bit of that back as an agriculture SR&ED levy on their tax returns. So this is similar to that, although instead of the PGA doing the R&D, you're doing the R&D yourself, right? So again, one of the more common credits I see among small businesses is SR&ED. So for the SR&ED, if you're a Canadian-controlled private corporation, the federal component of SR&ED is an investment tax credit of 35%. And then the Alberta component of SR&ED is an 8% base tax credit, and then plus a 12% enhanced credit. So potentially up to 20%. So overall, you can get potentially 55% of whatever you're investing in R&D. So the calculation is a little more complicated than that, but just a simple example, say you invest $500,000 in R&D expenses, then you could in theory get up to 55% of that back, which is $275,000. So it can be a pretty good chunk of change for a lot of corporations. So I'll talk a little bit about the eligibility requirements for SR&ED. The eligibility requirements are fairly vague on purpose, because they want people to use the program, and really they want you to be innovative. That's the purpose of it, is to try and foster innovation within the Canadian market. So one main criteria is you must try and solve a scientific or technological uncertainty. You must be trying to do something that no one else has done, or if they've done it, they have not succeeded, right? And then while you're trying to solve that scientific or technological uncertainty, you must utilize the scientific process. So you must, have a question, formulate a hypothesis, do experiments, review the results of the experiments, and come to a conclusion. And all of this is on your corporate tax return when you file. There's separate schedules for SR&ED. And basically there's a list of questions you have to answer. There's only 3. They're not actually that detailed. But probably want to put some thought into answering those questions. So I deal with a number of clients that utilize SR&ED. It can be a pretty good tool when we're trying to do something that is really any sort of R&D type work. One thing I will mention about all these credits is there's refundable tax credits and there's non-refundable tax credits. So SR&ED is a refundable tax credit. And what that means is that it doesn't just reduce your taxes owing, but if you don't have any taxes owing, the government will still give you a refund. So let's just say, for example, in my example there, the $500,000 that you invest in R&D, let's say you have no tax liability that year. Well, since it's a refundable tax credit, it doesn't matter if you have a tax liability. The government will still give you back your $275,000. They'll send you a check for $275,000. But if it's a non-refundable tax credit, then it only reduces your tax liability. So if you don't owe any taxes, you don't get any money back. What that does is the investment tax credit will carry forward, and then you can use it against future tax liabilities. So refundable tax credits are generally what someone would want because they're going to get that cash back regardless, right? Whereas non-refundable, it just reduces your tax liability. So I mentioned this briefly before. How to apply? You apply this through your corporate income tax return. There's no special additional form that you need to fill out separate from your corporate tax return. Your accountant can help with that. Or some people have consultants that just specifically do SR&ED, which I'll talk about in a bit more later on. So SR&ED's a pretty common one. The other common one that we see among producers is the Clean Technology Investment Tax Credit. So this is a 30% refundable tax credit. So going back to non-refundable, refundable, this is the good one. It's refundable on the cost of eligible clean technology equipment. So there's a whole definition of what eligible clean technology equipment is, but the common one that I see is solar panels. So I'll go into the eligibility in a bit more detail, but just to give you an example, this is like the most common example of when I see this used is farmer invests $600,000 in solar panels. They will receive an investment tax credit of up to 30% of that $600,000, which is $180,000. So very common tax credit that I've seen a number of businesses use. It's a very good way to lower your energy costs while recovering some of that upfront cost.
Just
So,
if I may, there's some
yes,
stipulations in that are requirements of the installer paying
there's
their
some labor
staff
requirements. Yeah.
paying their staff prevailing wages for the area. Like for us, for instance, it
Mm-hmm.
raises our labor almost 30%
Yep.
to achieve that tax credit status. But that, of course, increases the retail price, which increases the percentage paid out on the
Yeah.
credit, which generally goes to you guys.
Yeah. So to Scott's point about that there's a labor requirement where we have to pay the individuals who are actually installing the equipment a certain amount. Has to be equal to certain labor standards. The if you do not meet those labor requirements, it's not a 30% refundable tax credit, it's 20% refundable tax credit.
Which is still a benefit, but
It's still a benefit. It's just, it cuts it in the third. So
yeah, but then this is how the government gets that tax credit back is the income tax from our employees pay for the whole program.
yeah, yes. So pros and cons, right? But
Yep.
another point I will make about, since I was going to mention that as well about the labor requirement, is that the other downside that I've seen with this credit in particular is the CRA has decided that they are going to audit 100% of these claims, which has resulted in a fairly big backlog of claims. So what ends up happening is you file this clean technology investment tax credit with your corporate tax return. You don't actually get the money back yet, right? You've already paid for the solar panels. You don't get the money back yet. The CRA, because they're auditing all of them, will send it to their assessment division. And then only once they've gone through and done their audit, then they will actually release the funds. So I've had a few clients that have done it, last year, March last year, and they still haven't got their refund yet. So it is a great tax credit, although don't count on getting your money right away, is what I'd always tell clients. So eligibility wise, since we kind of skipped that, so the clean technology equipment must be equipment to generate electricity from solar, wind, water energy. There's also like certain stationary electricity storage. Biogas, exactly. Yeah. So it's really any equipment that does not use fossil fuels. is what they're trying to get at with the clean technology investment tax credit.
Now, is there still oh God. The accelerated depreciation is still in phase out mode, right? So that's still part
Yeah,
of this too.
it is still part of it as well. Yes, yes, you get accelerated depreciation on the asset. So in a way, you get to double dip a bit.
Yeah, I think there's 3 years left or two.
I don't recall off the top of my head. I can actually take a look at that really quickly.
It's just
I'll
because
just
I know
open it
they're
up on another
phasing it
screen here.
out to bring in the CEIT.
Yeah, yeah. One second here. I'm just gonna quickly look that up.
Sorry if I threw you off a little bit.
That's okay. No worries. Investment tax credit. Okay, I'll have that. I'll look that up on the side here while I keep going here. So, this, I would say, as far as the credits go, tax credits are concerned, clean technology is probably the major one that I've seen, as well as SR&ED for very specific businesses that are doing R&D. So I'm going to jump ahead and go through a couple of the other tax credits as well here. Now, there's a clean electricity investment tax credit, which I would say is not one that I see clients utilize that much because it is very, very similar to the clean technology investment tax credit. So basically what I'll say about this credit is it's a 15% refundable credit. So again, refundable, which is good, on new equipment to generate, store, or transmit clean electricity. Well, that sounds a lot like the clean technology investment tax credit. And it is. There's a lot of overlap in here. This one's a little bit more broad in what qualifies for the clean electricity investment tax credit than the clean technology. Common question I'd get then is, well, can I use both? Excuse me. And no, you cannot use both. So that's why, clean technology is what will more utilized. It's a higher refundable credit than it is for the clean electricity investment tax credit.
If I may,
So,
would you not be able to use the CTIT on the solar and then the following year or on a separate invoice add storage and use the CEIT?
but potentially, I'd need to look at exactly kind of what you have going on before I could say that for certain. So maybe I'll say maybe.
So
I
you're
know that's not a
saying there's
great
a
answer.
chance.
There maybe is a chance. Yes. So
Okay, thank you.
yeah, no problem. They do have a lot of stipulations if you look at the guidelines for a lot of these credits where they really don't want you to be able to double dip. So you might fall into something like that, but it depends. So again, with this one, you apply with schedules on your corporate income tax return. So it's not a separate application process, which is different with some of the other credits. This one, all the ones that we looked at so far are applications on your corporate income tax return, which you file at your fiscal year end. So I want to mention this one because it was initially brought up when I was asked to give this presentation about the Alberta Agri-Processing Investment Tax Credit. This is not one I see a number of businesses use, particularly just because you need a giant investment in order to be able to utilize this credit. So this is a Alberta credit, not a federal credit, and it is a 12% non-refundable tax credit on capital costs to build or expand a value-added agri-processing facility. So you need a minimum of $10 million investment in order to be eligible for the Alberta Agri-Processing Investment Tax Credit. So, in simple terms, let's say someone invests $20 million in a value-added processing facility, which I'll describe what that is in a second. They'd receive a non-refundable tax credit of $2.4 million on their Alberta tax liability. So since it's non-refundable, that means it only offsets future tax liability. So if they're not paying any Alberta tax right now, they're not really getting any benefit from this until such time as they pay that Alberta tax. So we're talking bigger numbers here than some of the other credits. You need to have a very substantial investment in order to utilize this credit. So, I have in here this provides a leverage to expand. It brings processing in-house. I think basically what I said is, this credit rewards moving downstream into processing. But there's very specific requirements. This one is a lot more detailed in the requirements, given the dollar values we're talking about, than the other credits. You need to invest at least $10 million. you in a value-added processing facility, which means physically transforming or upgrading any raw or primary agricultural product or byproduct into a new or upgraded product. So think about, canola processing, meat processing, potato processing, making potatoes into hash browns, things like that, right? So it is very specific. I particularly find, this is just kind of a side note, since this is an Alberta credit, most of the time when Alberta has credits, they are way more detailed in what they actually require than I've seen sometimes with the federal ones. For instance, I mentioned the Alberta Innovation Employment Grant. For whatever reason, it doesn't exactly follow SR&ED. It's slightly different and they made the rules more complicated. But Peter, did you have a comment or question?
Yeah, I just wanted to clarify. So if a
Yeah.
processor builds a $100 million facility,
Mm.
do they get the 12% tax credit on that full $100 million investment? Or is it just like, is there
Yes.
only certain pieces of that $100 million investments that are eligible? Because
Well,
that would include
it's
capital, land, equipment.
it does include all capital, land, and equipment, but in the rules of the credit, they're very specific as far as like this works, this applies, this doesn't apply, right? So you do have to break it down and look at exactly all of the individual equipment that you are purchasing, because likely a lot of it is, but some of it might not be.
Okay, so then in their first year of operation, they owe, I don't know, $500,000 in taxes or whatever it is at the provincial level, and that just
Yeah.
gets credited off of their bill, basically. So they don't pay that 500,
Yes.
it's just being eaten up.
Exactly. Yeah. And there is a limit too. You can only use, I believe, I don't have the numbers in front of me, but you cannot use 100% of the credit in the first year. So in my example there, or your example, I guess, with $100 million, your credit is 12 million. So if you had $12 million of Alberta tax liability, you couldn't technically use up all of the credit to just offset that one. You have to use it over 3 years, minimum
Okay.
3 years, I think maximum over 10 years. I don't know exactly with the 10-year part, but there's a lot of weird little stipulations in this one. And to your example of the $100 million, they should know in advance what credits they can use, because unlike the other ones where you're just applying as part of your tax return, there is quite the process to apply for this one. You have to apply for conditional approval first through the government of Alberta. There's like status report requirements you have to do to update them on what you're actually doing, and if it agrees to what your original um, uh, application form says, and then there's like a final certificate application. There's like a whole process you got to follow for this one. So any expenditures after February 2023 can apply for this as well. And I cannot remember the end date, but it is quite a ways away, quite a ways out. So, all right. Oops, I went backwards. So, this one's a smaller one. I'll maybe mention it. It might apply to some producers out there, is the apprenticeship job creation tax credit. So gives a 10%, again, it's non-refundable credit, available to employers who hire and train eligible apprentices in certain skilled trades. So, we're thinking welders, mechanics, electricians, those types of trades. So how it works is you get equal to 10% of eligible salaries and wages paid to employees. You get a credit of up to a maximum of $2,000. So, give an example here. Let's just say you hire 2 eligible apprentices, pay them, I don't know, let's say 50 grand a year. The farm will receive a non-refundable tax credit, or the corporation will receive a non-refundable tax credit of $4,000 total. So it's 2,000 each. So we're not talking huge numbers here, but if you do happen to have eligible apprentices, then it might be a credit that is worthwhile. You might already have it. I have a number of clients that didn't even realize that this was a thing. So it's something worthwhile to mention. For eligibility, it must be salary and wages paid to an apprentice in the first 24 months of their apprenticeship that are employed in your business. And this one, similar to some of the other credits, this one doesn't have a certain form. You just file it as part of your tax return each year. So, directly lowers the cost of training welders, mechanics, electricians, anyone that you might be hiring directly on the farm. Now, a lot of the time, we're not hiring that directly in the farm. We are hiring a third party to do that, but I thought it's worthwhile to mention that as well. So, those are the main credits that I wanted to mention that we see fairly regularly. In addition to credits, I often tell clients, don't stop at credits. Investment tax credits are great, but there's also other funding opportunities out there as well. So, and there is often the ability to stack credits and grants together to make sure that we're offsetting a larger chunk of the cost of whatever we're investing in. So, I've talked about investment tax credits. A lot of the ones I talked about are kind of the 10 to 30% range. There's SR&ED as well, which can be up to 55% on R&D. We also have a lot of other grant funding that I'll talk about next in a little bit more detail here. And then I want to talk again about the purchasing decisions because that does impact some of our credits and grant funding. So let's chat about some of the grants. This one is probably one of the most common ones that we see for producers in the area. So it's the Sustainable Canadian Agricultural Partnership grants, delivered in Alberta as kind of a cost-shared grant program. So if you were to Google SCAP in Alberta and go to the Alberta government's website, they've got a pretty good website that breaks down, there's a ton of grants as part of the SCAP. I'm going to talk about two of them. But if you go to their website, it's laid out actually quite nicely, and it'll break down all the grants. It gives a little checkbox of like which ones you may be eligible for just at a first glance. You can click on them all and they can go through a lot more detail. So it's a nice website to look at. So two most relevant ones that we see would be the on-farm efficiency program, which provides up to $150,000 for smart farm technology, really anything that makes the farm more efficient. And then we also have the on-farm value added, which is up to $50,000 for any value added investment that you're making. And I'll talk a bit more about them in detail right now here. So the on-farm efficiency one, so the intent is to support producers in achieving environmental benefits, improving the efficient use of agricultural inputs. So the program funds primary producers to carry out projects that optimize the use of inputs such as fertilizers, pesticides, and energy. The eligible items, they have a big list on their website of what is eligible for this, and it's quite extensive. And it even says what's not eligible for it too, which is nice. They're broken down into different categories with like smart farm technology. There's certain energy efficiency investments, farm security, grain handling are kind of the main categories that they look at. So I'd encourage you, take a look at those if it's something you're interested in looking into SCAP, because there's a lot of different potentials that could fall under that grant. Then there's the on-farm value added program, which it's based upon adding value after harvest or slaughter. So it's about including adding processing capacity, expansion, food safety improvement, any investments in that. If you have some new product or process development that you're doing, it doesn't have to be actually an asset, right? There are some, if you are spending time and to set up a new process, I believe that can fall in there as well. So again, similar to the on-farm efficiency program, there is a lot of there's a big list of things that could potentially fall into that as well. So how this works is they're cost shared arrangements. So you fund a portion and the grant funds a portion of it. So the rate's generally 50%. So, you have 100,000 investment, you fall into the grant covers 50,000, you cover 50,000 yourself. Given that this is a grant, how it works is you got to apply for it, right? So watch for the intake windows because the programs, open and close by fiscal year. So I believe they're not open again until I want to say September of this year. So something you're going to want to plan ahead for is applying for the SCAP. You don't want to do it after the fact. You want to make sure you're thinking ahead a little bit. So what I wanted to mention is a couple other things. I'm not going to go into every grant because I could spend all day going through grants with you and going through eligibility criteria, and that wouldn't be fun for any of us. I just want to highlight and let you guys know that there is a lot of different grant opportunities out there. I mentioned IRAP here because it is one I see a lot. So I should know what this stands for off the top of my head here. What is it? National Research Council Industrial Research Assistance Program. So if you're doing R&D work and you have a SR&ED claim, you probably are eligible for IRAP. So, there's potential you can get a little bit of both there. That's one specifically for R&D and work similar to that. There's also a lot of other grants out there, potentials, types of funding you can get. There's some Agri-Innovate grants. There is the Canada Summer Jobs Grants, Canada Alberta Jobs Grants, Seasonal Agricultural Worker Grants, Temporary Foreign Worker Grants. There's lots of things that you can get. what I want you to take away from the grants is a couple of things. One, we can often stack grants with credits. I have it brackets in some cases because there are rules in place to make sure that you're not double dipping, but that doesn't mean that it can't still be beneficial to add them both together, right? So oftentimes the rules are in place not to make you so you can't have two grants that offset costs, but just to make sure you're not getting more than 100% of your whatever you're buying, right? Because what no grant program wants to do is you're buying $100,000 equipment and somehow you've managed to get $150,000 for that $100,000 equipment. So that's what it's all about there. So a lot of the grants that you can look at are non-repayable. They're just purely grants, but there's also a lot of other funding out there with, there's forgivable loans, there's 0% interest loans, low rate interest loans. There's lots of different options out there as well. One thing that I always recommend for clients is to apply for these things before you invest, and to speak to your accountant about possible grants and credits beforehand, because oftentimes I find what ends up happening is people will do something and buy something, clients, and then they will come and they will say, hey, I did this. Can I get this grant or can I get this credit? And then sometimes I have to be the one to tell them, well, no, you don't meet the criteria for it. And then, no one's happy. So always good to speak to your advisors beforehand. And a couple other advice I will give too about finding grants is one tool that I have found quite helpful is actually utilizing AI for grants. There's lots of different AI out there. I don't know if you guys on the call are very familiar with AI, but Claude is my favorite. But we use ChatGPT, Copilot. One thing that you can do with some of these grants is provide it details of what your operation is doing, and then have it actually try and find the grants for you, right? So it'll just search the web and find grants that you're potentially eligible for. It's not going to give you all the answers by any means, but it can help identify things that you might not be aware of. In addition, there are also firms out there that's what they do, is just specialize in finding you grants. Avail partners with a couple of different ones, and we have free consultations. So if it's something that someone that you're interested in, happy to get you in contact with them and hopefully find you something that you didn't know you might be eligible for. So, okay. Last topic I want to bring up, because I think I'm running out of time here a little bit, is buying versus leasing. And some people might look at this and be like, what does this have to do with grants and credits? But it is relevant for it, and it's often the decision one of the decisions that you need to make when you're actually buying something, right? Depending upon what you're buying is, okay, we're actually going to buy this outright, finance it, or are we going to lease it? Pros and cons of both. What I'll do is I'll maybe walk you through some of them, but it's really dependent upon everyone's situation, what you're doing. So, buying a pro of it, to Scott's comment before, is depending upon what you're buying, there are rules in place where we can get some accelerated tax depreciation. Should we get a write-off quicker with what we're buying? That's not the case with everything that we're buying, but it is with some things that we're buying. So we have that accelerated depreciation. So that can be a pro if we're buying. We don't get that if we're leasing. Another pro is oftentimes, if we're buying, we have full ownership and control over the asset. Might not be the case depending on what we're leasing. Con of buying, though, is oftentimes, unless we're getting accelerated depreciation, it's a slower write-off. So we're not getting the benefit of that deduction over time. We might be paying a little bit more tax up front. And then oftentimes if we're buying or putting a large down payment down, we might have some more upfront cash flow tied up in that asset than we would otherwise if we're leasing. So a couple things to consider with leasing. Pro, unless there's that accelerated depreciation, we have a faster tax write-off with leasing generally. There also can be some better cash flow management than what you would get. You can spread it out over more time than what you get if you're buying directly. A couple cons, though, is you don't have ownership of the asset. And then another con, which ties directly into what we're talking about with tax credits, is if you're leasing an asset, you might not all the time qualify for some of the tax credits. You have to actually own the asset. So that's something to consider too with buying and leasing is, oh, okay, well, does that change what kind of grants I can get if I'm actually leasing this versus buying it? Which it probably does. So, this is a very, very broad rule of thumb, but if we are planning for, long-term use of an asset, it probably makes some more sense to look at buying it potentially. Or, if we want flexibility and we want to make sure we're preserving our cash flow a little bit, maybe it makes more sense to look at leasing. So I always recommend though, you got to model it out before you're deciding. So again, that's something you should talk to your accountant about if you're looking at buying or leasing something. So last thing, I'll just put some key takeaways here. So um, don't just stop at one credit. Let's look at a broad overview of what you can potentially get for a project that you're working on, because there's oftentimes we can stack some things together and get you a little bit more back than what you'd otherwise thought. So it's important beforehand to actually look at, okay, well, what type of credit can we get for this investment? And then also, as much as you can, it's good to time purchases to maximize deductions. And what I mean by that is, some of these credits are for a long period of time, but oftentimes with these grants, they're for a set period of time. So you can't always time purchases based upon when a grant or something or when there's credits, but it's something to consider, right? Is, oh, okay, well, we want to have this investment in the next 2 years. This credit is only around for a year and a half, so maybe we want to consider purchasing it earlier so that we fall under this credit, which we may not otherwise. And all of those things can be discussed if you plan with your accountant before you actually spend the money, right? So it's always good to be proactive rather than reactive to this. I love being proactive with my clients, but I can't be proactive if I don't know what's going on. So it's always good to plan ahead of time with your accountant ideally before you spend anything. So that's everything that I have for you. Any questions? We got a small group here, but anything that anyone wants to discuss?
If you have a question, throw your camera on and leap in. I'm happy to start off the discussion. So, Devin, you've got a grab bag of community leaders on the call here, looking through the names of people here. These are the folks who they probably aren't going to be using the tax credit directly, but they're going to be telling other people about the tax credit,
Yes.
particularly when it comes to working with business owners to land investment attraction deals in their communities.
Mhm.
What advice would you give to those community leaders on how they can best arm themselves with this often technical information in order to bring it forward for discussions with businesses?
Yeah, that's a good question. Um, I would say my initial thoughts are, at least for all of these credits and anything else that you guys come across, have a general understanding of what the credit is for and how it works, as I know you guys would already do. Um, and then, I think it's a matter of just being able to at least speak at a higher level about some of these credits. I would suggest, not necessarily getting into the weeds with the credits and recommending that individuals, businesses talk to their accountants and advisors about some of these credits in more detail, because it's really easy even for myself to speak out of hand and say, oh, this credit applies to that, and it's like, well, it doesn't actually because of this weird rule, right? But it's good to know about what these credits are so you can at least say, hey, look, we have these other credits that you can potentially apply for. And then always recommend, I would say, that they speak to their advisors about them in more detail. So
And I guess the second part around that is, would
yeah,
you be willing to share this presentation so that we can send it out to the members of SouthGrow so that they basically have it? It's got your branding on it, of course, but then they have
sure.
the thing in hand and they can hand it to their rec dev and be like, hey, make sure our incentive packages is up to date and that this information is available for council if we have conversations.
Yep, that's fine.
Perfect. Yeah, you see the mayor of Colehurst there just dropped a big old thumbs up. Yeah,
Perfect. I like it.
cool.
Anything else?
I'll add too that we've got Penny Dagnon on the call today. So Penny is the director of fund development here at SouthGrow. So Penny and her team, there she is. If anybody in your community, if you're a SouthGrow member and either your administration or a nonprofit or charity in your community needs help with grants and understanding the grant environment, you can reach out to SouthGrow and connect them with Penny and her team, and they'll help them understand the opportunities that are available to them. We can also do things like help to come in and demystify some of the stuff that Devin's talked about here today. I'm also sure Avail is very happy to come in and demystify that too, because they do their own business development goals as a for-profit company too.
For
But
sure.
there are resources available if you've liked anything you've heard today or you think your people need to know more about it, that you can get that presentation into your community and directly to your people. And Devin's presentation, you'll have your own contact information that you can share there too.
Yes, yeah, exactly. And I'm happy to help
Yeah.
out if anyone ever feel free to reach out. So, um, I often tell people too, there's even if there's some little minute detail that you don't think is relevant, it's often good just to share it because there's been some times when clients have shared like, I don't really think you need to know this, but I'm doing this. I'm like, oh, I do need to know that because we can potentially get this for you, right? So
Penny, do you have any things to share about how you work with somebody to understand if they have a project that fits one of those funding opportunities or not?
Yeah, I think the first place I would start is the eligibility criteria. So you can be eligible as an applicant, but your project can be ineligible and vice versa. So making sure you as an entity or a partner that you have can serve as an eligible applicant, and then making sure that your project scope falls within the things that a funder wants to fund. So capital versus non-capital. If it's for capital costs, but those aren't eligible, it's probably not a great fit. So I think that would be where I would start. And then once you've established that you're likely eligible or your project is, reaching out to the funder and having conversations about your project. So they can often on the phone tell you things that maybe they won't put in writing just to give you advice or to say, the committee doesn't really like this kind of a project or they really like this kind of a project. So giving you advice on how to position what you're planning to do. That would be in terms of grant writing. I feel like the tax credit piece is either it fits or it doesn't, and it's checking boxes on your tax return. So the advice I would give is those are the two things I would start with and getting those conversations going with funders.
I actually either have an hour of questions or no questions. So does anybody else have any questions on the line? We'll get the presentation sent out to everybody who registered, and the marketing team will be putting this video onto the SouthGrow YouTube channel in the future if you want to share it with anybody out there. We occasionally send blasts out reminding folks that these videos do exist if you want to share them around your community or somebody who might be interested in finding out more. And of course, Devin's contact information will be available in the presentation as well. Devin, thank you so much. Do you have any last words for the group?
No, talk to your accountants. That's my last words.
Yeah, they're worth their weight in gold, literally.
There you go. Yeah, exactly.
Excellent. Well, thanks, folks, for coming. Happy to give you back the last 10 minutes of your lunch break and appreciate you spending your time here with us today. Thank you.
Thanks.
Thank you.
Watch for the next, Madison, what's our next event in August? Do we have a title for that Lunch and Learn? Oh, you're muted, Madison. Sorry.
No title yet. We're working on something fun and creative, but it's the third Wednesday in August.
You betcha. It's going to be about data centers, I think.
Yes.
Yes. So look for another invitation for the next Lunch and Learn about data centers in August. Thanks, folks, and have a great day.
Thanks. See ya.
Bye-bye.